Good GameStop. Really still playing way out of your league. So the Dow had been way up at 316, and now it's down to 314, so 200 down overall. We had a low of 313, so it's at a 300-point range today, and now it's the lower 1/3 of that 300-point range. S&P is just sort of deteriorating along. The NASDAQ, really sad, really sad on the NASDAQ. This is not good. We're making new lows now as we speak. Oil, although oil's going to hit our 62 goal. We remember I said, oh, well, in the chat room, we were just talking about this. Brent, okay, sorry, GameStop. Brent oil, you should see, the thing is you got to watch Brent for resistance too to see if it's going to hit a thing. So Brent hitting 65, which is still a bit away, would come around where oil hit 62, where Seattle, Texas oil hit 62. And that should be resistance. That's something I'm willing to start putting some bets back down. We gave up on our oil bets. And we didn't give up. I mean, we took the money and ran when it went below 60, obviously. That's exactly what we wanted it to do. So, now we want to reset, but I don't want to reset too early because we went all the way up just a couple of days ago. We were up at like 63, right? So, it's not go. We don't want to take a massive loss, so there's no reason to play it when it's too high. Oil, hourly. Yeah, see, 63.50 is where we topped out. So, it's very tricky when it's at 62. You're like, well, it was just at 59.50, so why can't we bet it here? But you can't do that. You got to wait. You got to let it show you where the top is. Don't force the top. The way you bet oil is when it's coming down and it breaks below your support level. That's when you want to bet it, because that way the momentum's in your favor. And when it comes back over is where you stop out. So in other words, you say here, profit, 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 and obviously you should be setting your stop lower by then. So when you're down here, let's look at this. Let's say we thought 63 was going to be the top. So here you have a successful 63, and it goes down and down and down and down. And every time it goes down a quarter, certainly if it goes down 50 cents, but if it goes down 50 cents, you're going to set your stop about 1/3 of the way back up at like 15 cents higher. At 75, you get back out. So once you're down 50 cents, you really want to stop out around here, but then you can use that same line as your next breakdown line and get back in. And here you would have been in and out a little bit, but then you catch one nice ride down. Then it stops you out, of course, somewhere around here. Then you probably wouldn't get back in here because your line was 63. But then you wait. So then you wait. You don't get back in when it's going up over 63. You wait for it to break below 63, which it would have done here. So it would have done it here and stopped you out. Then you wait and wait. Never gets below 63. Never gets below 63. Then you would have gone here and stopped you out at some point. Then it never goes below 63 again. Then here's 63. Down here stops you out. Down here, and a big success. And then it doesn't go back over. Like that. We had played this with conviction and we took it all the way down to 59.50, but that was, we stopped out at 60 and that was plenty. So now if we're going to reestablish, though, we're not going to reestablish here when we started shorting last time at 63. You just got to be patient. You got to sit back and just play it out. So, you don't want to overdo these. The same thing goes for the indexes too. Where are these things? You look at the indexes, we were shorting the Dow up here, we were shorting the S&P up here, we were shorting the NASDAQ up here, and we were shorting the Russell up here. So we're not running back in just because they're bouncing a little bit. Look at the NASDAQ, it's really failing now too. You just got to wait until it shows you where the top is. You can't force these things. If you force them, this is how you lose your money. You gotta wait until you see and say, oh yeah, that's definitely giving it trouble. That's a place I don't mind planting my flag, basically. Because don't forget, the whole key to our strategy is that you can win a lot more than you can lose. And the reason that you can win more than you can lose is because we're picking the high and low ends of the high ends of the ranges to play. So, in other words, we saw the NASDAQ topping out here, Let's go for a longer range. So the NASDAQ topped out here, and we played it short down to here. We caught this part of the range. That's all we do. Over here, we were playing this range for a while, and it's between 12 and 11. Then it went from 12 to 13. That didn't work though. We didn't make any money doing that. But then it went up to close to 14, and we started playing again, and we caught the short. That's all you want to do is play the range that you're in at the time, and that's going to change from time to time. But never play the middle of the range. Just play the top of it. You just got to wait. If it's not in the range, here we're waiting for it to get to the top of this range. So we couldn't play this whole time. This is a long time. November, December, January, until February, we couldn't really play this thing. Well, starting in January, I guess we could start playing it. It wasn't very successful, but we were playing it short. All right, then we get one nice payoff, then it starts going up again. The same thing goes with the rolls in the short-term portfolio. We roll when we're at the top of the range. It's the same thing. You don't just keep rolling. And as you can see here, doing very nicely, only down basically flat. So we're back to 200,000 now on the short-term portfolio. And when did we look at the short-term portfolio? Was that like Friday? We just looked at this thing. It wasn't Tuesday. Was it Monday? I don't think so. Might have been. Nope. Monday was other nonsense. Friday. Damn it, I know I adjusted it. Oh, there it is. Oh, well, oh, no, that's not fair. The STP, the short-term portfolio is up 12% on Friday, but this TZA got zeroed out. So there was $11,000 there that got zeroed out because of the change in TZA. So if you look at these STP now, oh, that doesn't make any sense. Nope, it's not zeroed out. All right, so the short-term portfolio is down. How can it not be zeroed out? What do? They put back the prices of the old options? I thought we got automatically reassigned. TZA. We can't find that because instead of seeing it. Oh yeah, they kept the old options. Oh, it's so obnoxious. I don't know if Thinkorswim did that, but they did that. So where are we? So now we're priced back at where we were on the TZAs because they kept the old options, but they've done something weird with the June 4 calls. What? That makes no sense. Anyway, it's all screwed up. Bottom line, all screwed up. So you can't go by this thing. You can't go by the net. The positions are right though. But here's our positions in the short-term portfolio. We press them when they're near the top. That's what I was saying. And we cash them in when they go to the other side of the range. If they drastically move in a direction, we take advantage of that. So far, we don't have any reason to. Now, one thing we have in SCO on oil is a 6/8 spread. We do have these March 9 calls. These are going to expire worthless, it looks like. It's not doing very well. Oh, we should look at that oil report. So we have the short April 8s. We have the long 6/8 spread, and we'll see how it goes. But we're not worried about it because here we've got a net $5,000 spread, right? You see these two guys in net 5,000. We sold $3,500 worth of short calls against them. So we're going to end up paying zero for this spread. So this spread is just for fun. And all we're saying is that oil is going to be lower than it is now, below $60 in January of next year. That's what our bet is. And if we get that bet, we're going to collect 75 times 2, which is what, $15,000. But we'll be net zero by then, so it'll be all profit. We did take a loss on the 9 calls. We're down 25 there, so that'll be our loss. But we're still going to make that money back with the selling. So nothing to be alarmed about, for sure. And what was that? Oh, so Brian mentioned SKT is up to 18. Well, we're done with them. Where's that? That's in the long-term portfolio. We have SKT, but it's too late for us to make any more money off of that. Oh, they're also in the dividend portfolio, aren't they? I think. SKT here, Tanger Factory Outlets. We've got 8,000 long positions that we bought at 7. They're at 18 now. It doesn't do us any good though, because we sold the $10 calls and we sold the $17 calls. So they're at 17. So these are in the money. So we're going to blow out on this position. It's already very profitable. It's 86,000 minus 19 on the short calls, but then plus 13 on the other short puts. Of course, they're going to become worthless. And plus 11 on the other short calls, because even though it went up, these guys lost their premium, so they no longer have this ridiculous premium they had. Oh, I know, we hit that on the button. We talked about this already. We sold this on the button when they were at 20, so we caught that one perfectly. Oh, and why is that, by the way? I don't know if I caught that article this morning, but I read it this morning. Doesn't mean that it was a thing. Oops. Let's see. Something about the malls and the very tragic numbers in the malls. Very tragic nets. Should be an article at some point. Coffee roasters, Facebook, CO2 emissions, service sector, service industry, slowest growth in 9 months. Infrastructure sucks, of course, we know that. Intel paying $2.8 billion. Oh, how did that hit Intel today? Did anyone care? The stock of the year. Ooh, so down 75 cents on the fine. So Intel got fined $2.8 billion for infringing on patents. Not really, obviously a big hit, but it could have been expected. That's why. UK hikes corporate taxes is foreshadowing for what we're going to have to do. Oh, look, the whole universe could be a giant neural network. We're actually finding more evidence that we are, in fact, a simulation, as Elon Musk had said. We are everything, or our whole existence is a computer simulation. So that's fun. But that would be a good argument for determinism, right? We're all just doing what we're supposed to do. I think Tron made that point at one time. We're all just following our basic programming. Oh, nothing wrong with it. Simulation is simulation. So what? I mean, everybody's a part of something. Everything's a part of something else. So I mean, what would be the big deal? And that's just our interpretation of events anyway. So it just depends. So where were we? Okay, so Tanger Van Land, Alex. So the LTP is skyrocketing at 224. So we don't have anything to worry about there. It's in crazy territory. The short-term portfolio is flat and also well protecting us. The butterfly portfolio, that's not right. That can't be right. That seems like something's obviously giving us some bad math there. That's too much. Dividend portfolio, that seems right, 65%. Earnings portfolio, that one's right, 183 is really great. Future is now, about 100 of it. Yep. And money talk. we'll have a thing I'm doing a big conference in Toronto in June. Although now it's depending on what the rules are, it might be simulcast. That's a BNN, they're up in Toronto. So 62%. So that's good. Oh, here's SKT in there too. Now here we were a little aggressive on the same position. We bought them at 840. We sold, no, we weren't that aggressive. I'm sorry, we covered it. We did cover it. So this one's dead. So we're not going to make any more money on this, really. We'll make $10,000, which isn't bad because look at the cost of the spread. It was 84 minus 35 minus 24, so minus 55. Basically, it's like a $3,000 spread, not even. And we're going to make, well, we're going to get back. Well, obviously, if we get called away at 10, we're going to have $10,000. So basically, you make 100% on a little spread like this. Very conservative. All we did is back in March, I think we doubled down or something, but we started out with whatever, but we ended up with 1,000 shares at 840, and we covered them with the short calls. And somebody asked me the other day, like, why do you sell these in the money calls against a position? We sell it to lower our basis. This made our basis so low, it was 840 minus 350, so not even $5 basis, 490 basis. So we had a 490 basis on a stock that we bought for 840. So we dropped our basis to half, and if we get called away at 10, which is a very modest increase from our target, we make 100%. So why did we not do that? We bought the stock for a net 50% discount, and then we make 100% if it's called away at a 20% increase of where it was. It's not about making the most money from every position. It's about making money on every position. It's about giving yourself the best chance to have a win. Because if you don't lose, then occasionally you're going to hit a home run, right? If you always, again, it goes back to, I talk about it sometimes. If you're Ty Cobb versus, well, Babe Ruth's not a good example, frankly, because Babe Ruth also hit for average. Babe Ruth had a, I'm going to say 343 lifetime average. So, I mean, that's crazy. Ty Cobb was 367, but Babe Ruth was one of the top all-time average hitters too. Babe Ruth lifetime batting average. Oh, very good. 342. I was off by 1. Can't believe it. Ty Cobb 367 though. Ty Cobb. What? What? How dare you? 366? Somebody's messing around with the record books. I'm telling you, it's 367. Anyway, I mean, maybe they recalculated something. Yeah, maybe they changed the rounding rules, and that's why Babe Ruth and Ty Cobb both took a hit. Anyway, point was, or actually there's no point because it's not working. A typical home run hitter, like like Dave Kingman or something like that, like an average good home run hitter, they'll miss as often as they hit, but it's spectacular to hit the home run. But you're going to do a lot better for your team if you hit for average. And that was the thing about Babe Ruth. He did both. He hit for average and he hit home runs. That's why he was so devastating. That's why he's baseball. Everybody knows Babe Ruth. 100 years later, Babe Ruth is the benchmark for baseball. But the guy Babe Ruth eclipsed was Ty Cobb, and Ty Cobb only cared about his average. He only hit for average. But that's because, and accidentally, there was a year when Ty Cobb hit 9 home runs, which back in those days was the most in the league, and he won the Triple Crown. Because he always hit for average. He always hit his RBIs because he was hitting for average. But he never won the home run championship because he didn't hit for home runs. But the funny thing about Ty Cobb's 9 home runs, I think about 5 of them were inside the park home runs. He didn't, he just ran around all the bases before they got the ball back. So That guy would take advantage of everything. But that's what you got to do as a trader too. You got to take advantage of everything that comes your way, and you don't try to win it. And that's why I see too many people. It's everybody walks away from these nice, simple trades. You know, they're always looking for this and that exciting stock, and what about this, and this is the next best thing, and that's the next best thing. I don't care. I don't need to know the next best thing. It's fun. It's fun to bet on stocks in the future. We have a futures now portfolio. It's up 100%. You know, it's not like we don't do it, but on the whole, in the long-term portfolio, which is our strategic, you know, retirement plan portfolio, you don't see that stuff. We just took some speculative plays in the LTP, though. We'll go over those next, in fact. But if this ever changes, why do you not, what's going on with this thing? This is weird. And it's like stuck. So in the long-term portfolio, it's just basic stuff. You know, Total Oil, Alibaba, Berkshire Hathaway, China Telecom, which is suspended at the moment, Cisco, Foot Locker, Gilead. You know, there's nothing there that you just read about. Intel, here's Intel. We'll see how that's doing pretty good. That one's up nicely. So we've added a little speculation because you have to kind of speculate to find things that are reasonable right now. It's very hard. So yesterday and the day before, I put up a couple of plays for the long-term portfolio because in the long-term portfolio we don't have any short puts anymore. And short puts are kind of like our watch list. You know, we say, well, we'd like to have this trade. This Macy's is part of a play that we killed, but we didn't have any reason to kill it. I'm going to pay $2,600 to buy back short puts that are going to expire worthless. But you know, OIH, Oil Services, we were keeping an eye on, and they're doing okay. And HMY is a gold mine, and they're doing okay. You know, so they're ones we don't mind owning if they go lower, and we'll establish a bigger position if they get cheaper. But meanwhile, if not, we just collect the money. So so we want to have some of those short put positions, and what we did here. So one thing about this is you're always going for diversity. So you know, I'm always thinking like, what don't we have? So here I was thinking about what in the energy space, because we don't really have the energy space. We have these OIHs. And we think oil is going to stabilize at least $50, so it's not going to be like below 50 anymore. So we think that's good. The only thing we have is Total, which is really a future energy play. It's more they're getting off oil. Oil Services we have, but I don't think we have any other oil. Plains Pipeline, Valero. Okay, we do have those are our energy plays. That's and Valero is a refiner, of course. So what don't we have in the energy space? We don't have a tanker company, and we don't have NRG is just an energy producer, so more of a utility play than an energy play. So these are both stocks. Now, both of these are, I thought, ridiculously underpriced. Now, you know, tanker companies are always crazy. You know, they're generally owned by Greek billionaires, and they play games with the prices all the time. But when they're this cheap, and again, it goes back to the same thing, bottom of the channel, right? We had a chance to get it at the bottom of the channel. $7 was only 1.4 billion valuation. They made 413 million last year. That's 1/3 of their valuation they made in the year. And but they're not going to do that again. The potential is there, but they're not going to do that again. But while it's cheap, 40 million is what they're projecting this year. They should go back to doing 200 million a year, which means 1.4 billion is 1/7. So the PE is 7. Why would I not want to buy that? I mean, it's a good long-term hold. And they'll go up and they'll come down and they'll do this and they'll do that, but we're taking a small position. So what are we doing? We're selling 50, so you end up owning 5,000 shares of the 2023 $5 puts. So we're saying we'll buy 5,000 shares at 5 on your $7 stock. So we're paying this, which is below the low that it hit for the last couple of years. So we'll buy 5,000 shares at 5 for $25,000. But you know what? They're paying us $1.50 to sell the puts. So we're only going to pay net $3.50. So we're taking a 50% discount on 5,000 shares. That's our offer. They accepted our offer and gave us $7,500 cash. That's crazy. So we get to put $7,500 of cash in the long-term portfolio in exchange for promising to buy 5,000 shares of Frontline for net $3.50, 50% off the current price. And that's only what, $15,000 something dollars, $17,500, something like that. So we're getting paid $7,500 to spend $17,500 at worst. So net $10,000 for us to take this position. Oh no, I'm sorry, that wasn't net 17. Sorry, that isn't net. So it's net 17,250. But that's crazy for 5,000 shares. Why not? So that's how we end up putting these short puts in the long-term portfolio. And why? Because we've got $1 million of cash sitting around doing nothing. That means we got margin coming out of our asses. And all we have to do is here. So what's going to happen now is we're going to have this entry for Frontline. And we'll have promised to buy 50, which see Harmony, we did the same thing because it was cheap. And we're going to get $7,500 cash for doing it. What else? And the other one was NRG. NRG is a utility company. Utility companies basically are regulated, but they're regulated not to make a big profit, but they're also regulated not to make a big loss. And the customers are regulated. Everything's regulated. You can't buy electricity from whoever you feel like it. You get electricity from the electric company. These guys have a certain service area. In that service area, they will break even. One way or another, they will get their money. So, and also the reason I like them is because Biden's going to start spending on infrastructure. That's going to be a benefit for these kind of guys. So, as I said here, they make $1 billion a year. They're always going to make $1 billion a year. This is what they make. That's what they're basically regulated to make $1 billion a year. Yet you can buy the company for $9 billion. Will it go up and be a 10-bagger? No, it'll never be a 10-bagger. This was crazy. This is a crazy, stupid low valuation. Because again, they're regulated. You're basically guaranteed this is what they're going to make, and they're going to guarantee if we give out their dividends and all the same thing. So it's the same thing. Here we sold 10, so we buy 1,000 shares at 28, but they pay us $4.50 for that, so we're netting in at $23.50. So we're paying net $23.50 for the $40 stock. That's what our promise is, and we're collecting $4,500 to make that promise. So now, in one day, we collected $4,000 plus $7,500 is $12,000, dropped it into the long-term portfolio. For what? For promising to buy, what do we say here? 17.5 and 28 is 35, 45. So we promised to spend $45,000 on 2 stocks. We collected $12,500 on cash and margin that's sitting around doing nothing. But meanwhile, $12,500 is what? It's 1.2% interest on this, on the cash on hand. So utilizing only $45,000 of $1 million even if it was a IRA account, we're only using $45,000 of our available margin, of our available buying power, and we're putting $12,500 in the bank. That's 1.25% now added to our portfolio return. So that's what we do when we have nothing else to do. We sell some puts. We say, well, you know what would we buy if it got cheaper? That's what selling a put is. What am I willing to buy if it got cheaper? And that's going to be evidenced in the next day, because I know that specifically happened where I said, you know what, we missed this one, but so what? You know, and again, I've been looking for, which is, they're harder and harder to find. That's why we're getting a little more obscure with our stock picks. Well, I've been looking for value plays. There aren't that many of them. So Trox is a chemical and metal maker, specialty chemical, special metals. So if you're going to be ramping the economy back up, if you're going to be doing infrastructure, people need this kind of stuff. So it's a no-brainer. That one had gotten away. I wish I had caught this back at 10. It was, you know, I know the company, and this would have been great. We just weren't paying attention and it got away from us and went back to 20. But I said, you know what, so what? Because we can sell the December 20 puts for $5.40, and that brings us back down to $14.60. So the net is $14.60. So even though it got away from us, we're still paying basically the middle of the channel. So we're paying mid-channel prices, or maybe a little bit higher in the channel, for our initial entry of 1,000 shares at $14.60. So $14,060 of an allocation is being put towards this, and our allocations in the long-term portfolio are $100,000 for a block. So we're putting $14,000 into a, you know, 15% of an allocation block basically, and we're collecting $5,400 more dollars, just to basically keep an eye on them and see what happens. What do we want to happen? You think you might want to say we want it to stay above 1460, but no, not really. I'll be through. If it goes to 10, what we're going to do is roll these to 20 of something at a lower strike, and then we'll set up a very aggressive bull call spread that will be playing for it to go back to 1460, which is the top of our range. We'd probably play like a 10-4, 10-15 spread. So we'd love it if it goes low. We'd love to lose money on this, but the worst case scenario for us is it keeps going higher and we only make $5,400. Meanwhile, though, if it goes down, we're happy because then we can start putting some money into it, because all this is, as I said, it's not even a 15% of an allocation block for us. We're taking a very, very small risk on this thing, but also we keep plowing money into the long-term portfolio. It's more money to spend on other stuff. MFGP is a IT software for corporations. Micro Focus, this is called, and they're great. They're a really good, solid company. I was very surprised to see them down here. I thought that was crazy. Somebody agrees with me today. They're up 13%. It's possible, but you have to be careful because we have a lot of people who act on these things. So sometimes, like I put this in yesterday at 350 or whatever time it was. Oh, it was 350. Oh, well, yeah, 350. So I put this in yesterday right before the close. So this morning it's getting bought up. That could be just our people, though. That doesn't mean that I did anything, you know, incredible. It just means that I caught something, I wrote it up, and people acted on it. That's all. It's just thinly traded stocks. So don't get carried away. But again, it's the same concept, right? I said, I'll buy 20 of these for $750, but it's not $750 because we're getting $265 off, and then that's us in for I don't know. Then that's us in for $750 minus $265, which I guess is $485. So we're netting in for $485, which is back to pretty much where the lows were here. And we're taking a long-term play, but $485 times 2,000 shares is what, $9,500 basically. 97, I guess, probably to be exact. So it's $9,700, and again, out of a $100,000 allocation block, we're taking very, very little risk. Our worst case scenario is we own them in that $9,700, but we can make $5,300 just for promising to buy them for $9,700. That's a nice rate of return. That's a great rate of return on our cash. So here's another $10,000, right? More than $10,000. There's $10,700, and yesterday was 12. So now we picked up $24,000 for promising to buy 4 stocks in the long-term portfolio. And even in $1 million portfolio, we've now added 2.5%. So that $1 million of cash that's sitting around, we just collected 2.5% on it for promising to buy some stocks that we want to buy anyway. And that's what we like to do. Generally in the long-term portfolio, over the course of a year, we'll sell 12 puts at least. And those 12 puts generally expire in 2 years. In the second year, we'll do another 12 puts. So at the high part of a cycle, we might have 24 short puts open, although obviously we move them around and change them during that time. But we'll have 24 short puts available. We tended to go for like about $5,000 if we can. And that's how much? That's $100,000. So we're giving ourselves over the course of a year 5%, 10% returns just by selling short puts. And all the short put is promising to buy a stock in the future for a price that's lower than it is today. That's all it is. It's not even complicated as a strategy. And if we just do that, we outperform most pension funds. That's the crazy thing about it. Most of these stupid retirement funds that people put money into will not perform as well as that. And that's just a flat out put strategy. And that strategy is an afterthought of the long-term portfolio. That's just the top of the long-term portfolio up here. And what happened, because the market was shaky and toppy, we have purged all of our short puts, so well in advance, but we collected. See, here's a typical one. I mean, Macy's is one of the typical old ones. It was up 85%. We just think this Macy's, there's no way in hell we're going to worry about the $8 puts. So we don't see, it's just, I can't even bring myself to pay $2,600 to take it out. And of course, all these guys have short puts. That's a part of the overall strategy. But the first step in these trades, a lot of times, is just to sell the short puts. And then if it gets cheaper, we buy a bull call spread. Because what are we doing? We're buying the bull call spread lower than it was before. And that's it. We're just assembling a very sensible long-term investing strategy on high-value stocks that are underpriced in the market. And we're basically just betting they're going to return to value. That's all it is. And that strategy from October of 2019 has brought in 224% return so far. That's all we've been doing. And you can go back in the portfolio review section. Oh, not here. Here. You can go back in the portfolio review section and you can see every trade we've made. Every long-term portfolio trade we've made is in there. You know, and the money talk portfolio, which is up 60-something%. Don't forget, we don't even touch that one. Where is that? Oh, there it is, money talk. That's got its own section. And you can see every single call we made in that one too. You know, just going on TV, talking about the portfolio, building the positions one by one. It's only been a year. If you really want to learn how to build a portfolio, go back and review these things. It's just simple stuff. I mean, look at the stocks in the money talk portfolio are so basic. And why are they basic? Because I'm only allowed to change them on the show. So there's going to be long periods of time, months at a time, where we don't touch these stocks no matter what the market does. So who do I pick? IBM, Intel, Macy's, Pfizer, Tanger Factory Outlet, and SunPower. You guys know those are my favorites. You know those are like the stocks I was picking all year long. And we set up the same thing. We sell the put. Here's a sell a put. Sell a put, sell a put, sell a put, sell a put, everyone, sell a put, and pick up a bull call spread. Sometimes at the same time, sometimes later. Oh, I'm sorry. But with this one, because of the show, we don't really do the later. We generally do everything at the same time because I'm making a call live on these shows. You know, I think SunPower here received SunPower. We started with a put, and then we added the bull call spread. So did a show in November, sold the puts. Then in March, we said, oop, it's still a good price. So we did the bull call spread. up 1,000%, but unfortunately this one's down 2,000%. So so that one was up 1,000. That's the good news. This one was down 2,000. That's the bad news. But yeah, I mean, you know, if we just made the straight pick of SunPower at $5, we would have done very well, right? In fact, this guy, if we had just bought these calls and not sold the put, sold the short calls, we'd be up $52,000. But this is a, you know, not that kind of thing. It's a conservative thing. We didn't know what would happen. We didn't know the market would fly back up. We just took advantage of a cheap one. And I said, it's a no-brainer. I said, there's no way the 5-10 spread isn't going to pay off because it's ridiculously low. So we took 20 of the 5-10 spreads for a net of $2,600. And if it pays off, it pays $10,000. So that's almost 100% to make on that spread. And yes, we did make 100% on that spread. Great. Great. But we didn't make 1,000%. It went up 1,000%, but we didn't make 1,000%. But that's okay. We don't have to. This just goes back to Ty Cobb, right? We're hitting the singles. Sometimes hit a home run. Usually singles. That's what we're trying to hit, singles. But you know what we're trying not to do? Don't strike out. That's the point. Don't miss. Don't strike out. What did Beige and Ty Cobb both do more than anybody else in the world? Walk. They only swung at the pitches that they liked. What does a good venture capitalist do? They only swing at the pitches they like. They don't back every single play. You got to be selective. You can't just say, "Oh, I read this and it sounds good." And I get those questions every day in chat. People ask me all the time, what about this? What about that? What about that? And it's a lot of times it's a hot stock and the thing that's in the news now, or they did this and did that, but it's too late. Just today we were talking about one of those. We got a Beige book coming out. Not that it means much, but we'll take a look. Oh, here's Generac. So of course Generac, because they have the Texas thing and people are talking about generators and so on and so forth. So, but you know, Generac's a great stock. We used to love Generac. When it was freaking $30, we bought Generac all the time. Here's me talking about it in 2012. But you know, it was not an exciting stock, and it suddenly has exploded and gone into vogue, but not because there's any great surge in sales. Here, in fact, this is 2020. Okay, so let's take a look. We can easily see what the difference is. So all these years, all the way back to 2012, $30, $40, $50, you know, maybe 60, whatever. Here now you start in 19, it goes start 75, then 100, then all of a sudden 100, 200, 300, almost over 350. Wow, it's like, oh cow, those guys must have been selling like crazy, right? There must have been something amazing going on. But here's what they did. 13, 14, 16, 20, 22, this is good growth, 10%, 22, 24, 28, 30. 10%, more than 10% each year, very nice. Operating profit going up to 77, 100, 150, 230, 250, 350, 450. So great growth, great profit. But is it enough that in 2018, the stock is at Oops. Where was that? Oh, I see here. That's what I couldn't. So in 2018, at 50 bucks, stock was at 50. 2018, 2 billion in sales and 238 million in profit. Okay. So sales have gone up. Let's say for next year, 50%. Profits have gone up. 100%. All right, so 100% increase in profits, 50% increase in revenue. Very nice, good company. Certainly want to be in them for the long term. But does that justify a 250% increase in the price? Of course not. So we missed it. End of story. It's like, oh yeah, wish I would have bought it then. This is not fixable. I can't sell a put and make that up. That's not the way it works. So you got to, you got to pick some stocks that haven't done that already. When I look at a stock and I see that, I'm immediately going, nah, okay, I'm not playing that. I don't want to short them. I like Generac. I think they're a great company. I think they're going to keep growing. One day they'll be worth 360, but not today. So yeah, I wish I had bought them earlier in the year. I wish I had caught that dip when they were down. And that's one of the hard things. I don't do that, and I should probably do it more. Is I kind of, it's hard for me to buy something for 60 that I used to own at 30, even if 60 is currently a great deal. Like IBM, like Disney. Let's say Disney is a good example. Disney, as a rule of thumb, we would buy them if they were under 100. They're never going to be under 100 again. They're 200 now. Our buying point for Disney was 100 as a rule of thumb is when we would jump into Disney. Now they're 200. So it's going to be very hard, even when they get back to 140, it's going to be real hard for me to buy Disney for 140. And just psychologically, it's just like it's so much higher than we used to pay for it. So I try to find things that haven't gotten away yet. But it's hard in this market. It's so hard because so much stuff is trading at crazy numbers. Look at Royal Caribbean. They're not even operating. And if you look at and if you think about Royal Caribbean, I mean they're great. I love Royal Caribbean, great company. But this is $22 billion. They only made not even $2 billion in their best year, but that's still, it'd be 10 times earnings. So it'd be, if you say they get back to $2 billion, you're talking about 10 times earnings, a little bit more. That's not bad. But they lost $5-6 billion here. They're going to lose another $2.5 billion here. That's $6-8 billion hole. It'll take them 4 or 5 years to make that $8 billion up. So just to get back to where they were in 2015 as a company, it's going to take them until 2027, 2026 maybe. So what am I investing in? And they're not like a real estate company. They can't just buy. They can buy another cruise company, but debt-wise and everything else, it's problematic for them. But look at the bankruptcy risk here. Okay, bankruptcy risk, health of the company, financial score. They're not strong enough to go out like Barrick Gold. When Barrick Gold is down and losing money, I know historically Barrick Gold always goes out and buys other gold miners. If they're in trouble, other people must be in desperate trouble. And they take full advantage of that and they leverage their asses up. And you know who else does that? Hovnanian, the builder. Hovnanian buys up every regional guy who's in trouble. They're like, come to me, baby. When the market's bad, they have their lenders and their lenders know them and trust them. And they're not just looking at a score on a sheet. They look at Hub Navy and they say, we've been doing business with your family for 100 years. And you guys always do this. This is your strategy as a building family. This is how you guys do things. We know what you're doing. We're with you. We're going to buy this land up while it's cheap, and we're going to wait until the market comes back and sell it. Because they are primarily Northeast builders. And one thing, land, there's no more land. The same way there's no more Bitcoins, there's no more land. And the land in the Northeast just gets more and more valuable all the time. You know, as does land in most places. Oops. As does most land. So there are banks and lenders who are always willing to lend to Hub Navy, and there are banks and lenders who will always lend to Barrett Gold, things like that. That's not going to be the case. That's not going to be the case with Royal Caribbean. Obviously, I would like the strategy. If Royal Caribbean went around now and bought up like Princess Cruises and Carnival and things like that and took them over. But that wouldn't even be the end of it, because you can't just buy the boats. You have to refit the boats. The reason Royal Caribbean is a better cruise line, they have nicer boats, they have better facilities, so on and so forth. So they would have to bring their brand to the other lines, they'd have to upgrade them considerably, and that would just cost huge amounts of money. And then there's always the risk that this pandemic thing, you know, they may decide a year from now that, you know what, cruises are too risky. That's just a national or international health risk. And that we're going to limit them severely from now on or something like that. Who knows what's going to happen? But you don't want to be in anywhere where there's uncertainty. Same thing goes with the airlines. You don't know what's going to happen with air travel. We don't know when they're going to fix this thing for sure. We don't know how many countries are still going to have bans. You don't know if business travel is going to come back in any significant way for a very long time. You know, these are long-term scars that change people's habits. Same thing in Las Vegas. By the way, Shelly's dead. Shelly Housen from Las Vegas Sands. But he built his business on conventions in Las Vegas. And his casinos had massive convention centers. And it was all about the casinos and the conventions and the tie-ins and the this and that, right? What happened today? Las Vegas Sands sold their last property in Atlantic City. They divested 100% away from Atlantic City and went to Macau. They're basically just a Macau company now. Isn't that crazy? They left Las Vegas. What does that really say? What does it say when the people who, Las Vegas Sands, he doesn't get credit, but Las Vegas Sands was one of the drivers of the whole Vegas thing. They built Treasure Island, which was the Siegfried and Roy Casino, right? So they were the first ones with the great big show and the this and that, and they had the Sands and the convention center, then they did Treasure Island, and so on and so forth, and then they built the Venetian, and it was the Palace, and the whatever that other one's called, the Riviera, whatever it is. They built these massive casinos, and it was all, but it was all based on tying in the concepts of these conventions would feed the people and would put the seat people in rooms and so on and so forth. Now they think that's over. They don't think it's coming back. Comic-Con was just canceled. Because last year they did it virtually, and this year they said screw it. Because I don't think they made any money. Comic-Con 2021, and that's in Florida. Now San Diego Comic-Con virtual, Comic-Con 2021 has been canceled. That is crazy. I mean, those people would have shown up in mass. So I mean, it just shows you how bad and how long-lasting the effect is. You can't. Conventions are a downturn. That's bad for all of Las Vegas. You don't know when people are going to start going back to the office, or if people start going back to the office. I mean, a lot of offices have decided that this is fine. And if I don't need to be, if you're a Manhattan firm, and you might say, okay, it's a little less productive for people to work at home or something like that. But on the other hand, you're not paying, I would say, a couple of $1,000s a month for them to sit at a desk at least. I'm talking about like basic office workers. Somebody with a corner suite in Manhattan is paying $5,000, $6,000, $10,000 a month to be in that corner suite, to sit in that office, to use it 8 hours a day. So do you really need that? You're spending more money on the building than you spend on your staff, basically. So that's crazy. So a lot of companies are rethinking the whole concept, and you don't know the long-term repercussion for the REIT sectors. You don't know the long-term repercussion for real estate in general. You don't know the repercussions for the retail industry, for the restaurant industry that's built around. The expectations that there are going to be this many people in the city and this many people having lunch and this much stuff used. All these things kind of go out the window and change. And we don't know what's going to come back and what's not going to come back. And a lot of people are making these bets in the market that things will be back to normal. And the cruise lines are really a big picture of that. I don't know that people are going to jump right back on cruise ships next year. I know my kids won't. My kids love cruising. My kids get on a boat every chance they get. They ain't going back this year. There's going to have to be a lot of hard data to convince my kids that it's going to be safe to go back on a boat. And me too. I mean, frankly, I like cruising because I like spending time. I like cruising because my kids like cruising. I get to spend a whole week with my kids. That's what I like about cruising. I get to spend a week just basically hanging out with my children. So there's nothing I like better than doing that. Wow, Nasdaq's down 2% now. Cuomo says he's not resigning. Anyway, but how is Carnival going to make all this money back? How are they going to justify this valuation? Not Carnival, Rocker, any of them. It doesn't matter. Any of them. How are they going to justify these valuations? And the cruise ships, like a hotel, have to be maintained. Just because you're not using it doesn't mean it doesn't cost you money. Especially hotel rooms, got your taxes and all that stuff. Some of them are leased, not all of them are owned. And now you've got rising minimum wages. You have so many shifting things in the economy. I just think it's very foolish to sort of like just bet on things being back the way they were. And I know that kind of sounds contradictory when I say I like to bet on the same blue chips, but we think about these things. These are the survivors. The things in our portfolio, the things that survived, that we have said, okay, even in a pandemic, even if it goes on forever, we still think this. We still think Total with their alt energy policy is going to be a survivor in the energy industry. Alibaba is the Amazon of China. Berkshire Hathaway, obviously, you're trusting Warren Buffett to shift and do whatever he wants. China Mobile is a phone company in China. Cisco is the connectivity on the internet. Foot Locker is sneakers, and even if you're all casual, you're still wearing sneakers. Gilead drugs, of course, obviously very important. Barrick Gold mine is going to still exist. Goldman Sachs makes money no matter what happens. IBM still on the forefront of many new technologies. IMAX, now see, IMAX was a back to normal bet, and actually so far that's done very, very well actually. But we bought IMAX when it was basically priced for bankruptcy. Intel stock of the year, because again, computers, chips, things like that, people still using all this stuff. 3M makes masks. So there's one reason to have them. The pipeline company, you still need to move the gas somewhere, somehow. Pfizer, more drugs. Tanger, I like them because they're outdoor malls. These are outlet mall centers. I think they're going to be more popular than indoor malls, and I also like their whole business model. SunPower solar chips, AT&T is our phone company, Valero the refiner, Walgreens Boots, the drugs again, Wheat Precious Metals for the silver and the commodities, and they also do gold, and Western Union. It's the newest one we added. The basics. None of those things you say, oh, I'm not going to use that anymore. That's why they're still there. These are the things that we found during the pandemic that we said, well, how, what's going to hurt? What could possibly hurt their business? They're pandemic immune. And that's why it's a long-term portfolio. The long-term portfolio has that. But, realistically, our other portfolios have it as well, the same kind of companies, because it's that kind of environment. You don't trust stuff like this. You can't just let anything be a bet. Beige book. It is definitely beige book time. March 3rd. Let's see. Now, when you read these, you gotta, read into them and think about what's going on. So there are 13 districts. Keep that in mind. And you gotta watch the moderating words. So economic activity expanded modestly from January to mid-February. That's not nice. Wait, why are we cutting into a 6-week period for most? So expanded modestly for most. So 7 of 13, 8 of 13, modest growth. Most businesses remained optimistic regarding the next 6 to 12 months as vaccines are becoming more widely distributed. So again, based on what they're being told, which is they see vaccines becoming more widely distributed, obviously assuming they're going to be effective and assuming everything will get back to normal when everyone's vaccinated, they are optimistic. But where's the facts? We need, you don't know yet what's really going to happen. And by the way, I'm optimistic too. I think things will get back to normal. I think once everybody's vaccinated, even in Texas, we should start doing better. But that's still June. That's first and second quarter are tanked. This year will not be a good year. And we are pricing the market like this year is going to be a fantastic year. It's not. We are at a dead stop right now in the economy, and you can jumpstart it with $2 trillion, but again, it's if people aren't back out there, how are they going to spend it? What are they going to do with it? So consumer spending and auto sales mixed. Mixed is not good. Again, it's all-time high. We are at an all-time high. So we're in big letters here, all-time high. So does this language reflect all-time high? All-time high, does this language match? So consumer spending and auto sales mixed. A few districts reported slight improvement in travel and tourism. Overall conditions continue to be restrained. Look how careful they are with their wording, right? Restrained by ongoing restrictions. Despite challenges from supply chain disruption, overall manufacturing activity for most districts increased moderately from the previous report. Among districts reporting on non-financial activity was mixed, again mixed, the all-time high, mixed. Though most modest growth, most reported modest growth, all-time high over the reporting period. Some districts, that's less than most, sounds like less than 6, right? Noted that the financial situation experienced declines in loan volumes, but most cited lower delinquency rates and elevated deposit levels. So some people had declining loan volumes, but most are doing a bit better in the lending department. Historically low mortgage interest rates continue to spur robust demand for new and existing homes in most districts. So that's what you want to hear. That's a bullish statement, right? Robust demands, new and existing homes, most districts. Home prices continue to rise in many areas of the U.S. on balance. commercial real estate conditions in hotel, blah, blah, blah. On balance, commercial real estate deteriorated. What was I just saying, right? While activity in the multifamily sector remained steady and the industrial segment continued to strengthen. Districts reporting on energy observed a slight uptick in activity related to oil and gas production and energy consumption. Overall reports on agricultural conditions were somewhat improved since the other thing, blah, blah, blah. All right, now. Employment and wages. Most districts reported employment levels rose over the reporting district, albeit slowly. So slow rise in employment, all-time highs. Labor demand varied by thing. Many contacts noted continued difficulties attracting and retaining qualified workers. This is interesting. People aren't working, but you can't find qualified workers. So I guess all the qualified workers are working. You just can't find the people who are unemployed that's what this is saying. The people who are not working are generally not very qualified. So there's been a very large filtration of people who are not that qualified to do anything, and they no longer have jobs. And it's, how are you going to get those people back to work? What unqualified jobs? Yeah, and that's the thing. The Fed doesn't talk about this. Biden doesn't talk about it. Nobody talks about it. What are you doing for unqualified people? And that's a harsh word, but excuse me. What are you doing for unqualified people? What are we doing for unskilled labor? It's called. Oh yeah, that's the polite word. Unskilled labor. What are we doing to bring unskilled jobs back? Everyone talks about skilled labor, manufacturing, blah blah blah. How does that help the guy who used to mop the floor at McDonald's? And it's because think about the kind of jobs we've lost. All the maids in the hotels, the hospitality industry. People who work in movie theaters, the people who screw up the people who can't handle getting you a popcorn and 2 Cokes without messing up the order. These are the unskilled people who don't have jobs. We got to make jobs for these guys. They need a job. They got, these incompetent people who you hate every day, who drive you crazy in your everyday life, are out of work and they need money. And it's funny. There's we have a iPic by us, which is a fancy movie theater, and they reopened, and they reopened with like way less staff because what they realized during the virus thing is that the couple of management people, the managers who were manning the stations, were able to service as many people as they were when they had staff, because they were better at it. That's right, because they could easily fill these orders. It's not that hard to give someone a popcorn and a Coke at the movies, and then move the line along. Say, hey, popcorn, Coke, $6.95. Thank you. Have a nice day. Boom. Next. That doesn't work anymore. If you ever go to a movie theater, it's like amazing how long it takes you to get the food. It's just really sick. And you would think they would want to. You would think that they want to eliminate these large lines, but they seem to love them. I don't know why. And then think about the theme parks, Disney, all the food vendors, all the people. It's just all these basic people, all the incompetent waiters in the restaurants, all the slow bus boys. They've all been let go. All these restaurants, when they do attrition, when they've been cutting back their staff, they're not cutting back the good people. They're cutting back the people who aren't very good. And they're all sitting around at home not getting paid now. But there's 10 million of those people. The bottom 10% of our workforce is unemployed, and companies want to hire some people back, but not those people. That's what the problem is. So constraints on labor supply included those related to COVID-19 childcare, unemployment benefits. Oh, that's another problem we have, is people can't go back to work because because their kids are home. People in elementary schools that are closed have to stay home with their kids. There's no childcare. We've done nothing. We haven't really thought this out. Yeah, and there's no good answer for this one. I mean, it's tricky, but I mean, you know, if your kid can't go to school and they're young kids, you can't leave them. It's illegal to leave them. That's abandoning your children. But what are we doing about it? We haven't really thought this through at all. What we should be doing is paying high school kids to watch the elementary school kids and stay home with them. You should, like, you know, take one designated high school kid to mix with your kids, and then you go to work or something. And people, that should be organized better or something. But again, if we were testing people properly, then you'd feel more confident bringing a high schooler, and they'd say, "Oh yes, I've been tested," or whatever. We had a good testing program, then you feel comfortable that you're bringing in somebody who wasn't going to contaminate your kids. But that's messed up too. That's keeping a lot of people home who should be out there in the workforce. So the labor supply shortage is noted by contacts as most acute among low skill occupations and trade positions. Yes, right. That's what I just said. Constraints on the labor supply, child care, just what I said, unemployment. It's actually written this report. Contacts expect modest improvement, all-time highs in employment levels in the near term. Several districts reported modest wage increases for high demand positions. Upward pressure on wages to attract and retain employees. On balance, wage increases are expected to persist and pick up over the next several months. All-time high markets. Prices on balance. Non-labor input costs rose modestly, and steel and lumber prices increasing notably. Many districts, a rise in cost was attributed to supply chain disruptions and strong overall demand. All-time highs. Transportation costs continue to increase, in part due to rising fuel costs and capacity constraints. Reports on pricing power were mixed, with some retailers and manufacturers affected by input cost increases, reporting the ability to pass prices through, while many others were unable to raise prices. All-time highs. Several districts reported anticipating modest price increases in the next several months. That's what's really driving the market crazy, is this inflation problem. And then it goes district by district, whatever. So that's where we go. That's not the greatest. Let's see, questions? Doesn't look like an actual question. Basil said he had trouble with the audio. I don't know if anybody else is having that. Moses says, Cobb's career average is 366. It was reported as 367 for decades, but research in recent decades uncovered duplicate game, but he never played. He's entered into the stats. That's interesting. Oh, I see. So they put the same game in twice, where he went 2 for 3, and that added a point to his batting average. Properly removing that game reduced his hit total to 41,869 and lowered his average by a point. Aw, that sucks. See, and that's stuck in my brain at 367. Steve says, do you ever consider using a diagonal, often called a poor man's cover, instead of the bull call spread, so you can keep selling the call every month or two? Yes, we do when it's appropriate. But generally, I tend to go towards more of the set and forget kind of thing. So it's like we don't, and also I'm trying to minimize my layout. So it depends on how risky we think the market is. But in this kind of market, where we're very uncertain of what's going to happen, we'll tend to do more of the long-term covers, because it just lowers the overall cost. We're raising the amount of premium that we're selling up front, and we're lowering the overall cost. And don't forget, by the way, when the VIX is this high, you don't know that you're going to be able to sell premiums for that kind of price next time. So if I right now can sell, let's say, so if I buy, here's Intel, okay, let's look at Intel. So if I buy Intel for $60 and I sell the January 2023, let's say the 65 calls for $10, right? Now, you would say, okay, so you just want to sell the 65s for 10, you're going to lower your cost to 50, so you're going to call away at 65 with a $15 profit. That's your plan to make 33%. But you're saying, but I'm cleverer than you, Phil. I'm going to sell the April 65s for $2, because that way I will be able to sell for 2 years. I'll be able to sell maybe 10 of those and make $20, and you're only going to make $9. There's two problems with that strategy. Problem number one is you may not always get that kind of premium. This premium is unique to the market. So should the VIX shrink considerably and should the market become less volatile, you may only get $1 for subsequent sales. And then you would be back in line with the $9 we can get now. That's problem number one. Problem number two is if Intel spikes up. So in other words, if you sell those 6250s for 2 and 65 for 2, and Intel spikes up to 65, right? Now you can't sell the 65s for 2. So you would have to sell, then you would sell the 6750s for 2 or something like that. You sell the 67 for 2, and then Intel goes down. All right, you can get stuck having to sell a lower, so you know, let's say, so you sell for 2 and you do okay, then you sell another 2, and you sell the 67s, let's say it goes up, you sell the 67s for $2, that's great too. Now Intel drops 10% and it's back at 61. I'm sorry, I'm sorry, it's at 60 now. So it goes back 10%, and let's say it's at 55. Now you would have to sell the 60s for the same $2. So suddenly you don't have the option to sell those 65s anymore. You're not going to get the same spread that we've been getting. And so I'm going to collect $9 now for sure and lower the basis of my trade to $60 to $50 right now by selling these things. So I'm going to drop my basis to $50, put $9 in my pocket, and have the spread. Or if I'm doing the options, even better, right? Because I'm collecting against the other spread. That money in my pocket, I will be able to use to initiate another trade. So I will make more money anyway with that money. I'm not going to sit there and do nothing. I'm going to make money with that money. I'm doing that. I'm locking the position in, and I'm done with it. It's not my job now. You're basically making a job out of it. And it's not. Look, it's not terrible. There's a place for those things in a lower VIX environment. If I didn't think I was getting a good compensation for selling the long-term 65s, I wouldn't do it. But when you're going to pay me 15% of the stock's price to take a position that's 8% out of the money, so I'm getting basically a 23% premium on that sale, I'll take that. That's fair. And you're going to cut the cost of my purchase by 20%? Yeah, of course. And if my purchase was these guys for $20, the 45 for 20, now I'm buying the 45-65 spread for $10. I'm fine with that. I don't need to play games. I'm going to make 100% if this thing hits 65. So I don't need to play games. I don't need to maximize my profits. They're phantom profits. I would rather lock it in. I'd rather lock in the 45-65 spread, because even if it stays at 55, even if it drops to 55, I'm still going to get my $10 back. Then I might sell some short-term calls against my big spread, but only if Intel looks toppy to me or there's some other reason. And of course, if Intel does drop a bit, I'm going to sell some puts, and I can then widen the spread. So, you know, yeah, your idea is fine, and we do it sometimes, but as a rule of thumb, I would always rather have less money committed. I'd always rather have a low capital commitment, a low exposure to that particular trade, and then have most of my exposure put towards the next trade. If the stock gets cheaper, I will increase my exposure, and then I'm much more likely to play those kind of games. But if the stock is expensive and it keeps going up, I just want to be covered. I'm happy to make 200%. And again, we're back to Ty Cobb, right? We're back to, I'd rather make 200% 1/3 of the time and make 50% 1/3 of the time and make 0% 1/3 of the time flat, and then and lose maybe 10% of the time, which I know adds up to more than 100, but you know what I mean. In other words, I'd like to mostly win. If I can win most of the time, and I can win a decent amount of money, and I can do that consistently, I will make a lot of money. I have no need to play games. This system works fantastically and makes incredible amounts of money by just playing the straight up way. Be the house. Exactly how Las Vegas Sands made all that money. Be the house. Sell the premium. Sell as much premium as you can. If people are willing to pay me $10 for a position that's $5 out of the money, and I can't possibly lose other than my bet that says, here's my bet. I'm buying Intel for 65. Intel is 60 bucks. I'm buying it for 65. I'm going to sell these puts for 9 bucks. So I'm going to buy it now. I'm buying it for $55, and it's currently 60.34. I'm limiting my upside, but so what? I spent $10 to be in Intel for net 55, and Intel is now $60. So I already am up 5 out of 10. I'm already 50% up in the money right now, day one. If Intel goes up $5 more, I make 100% on my money. Plus, I'm going to sell, let's say, the 45 puts for 5 bucks. So now I'm going to be at net 5. So now I'm net 50 on Intel. I'm $10 in the money. I've only laid out 5 bucks plus whatever the margin is on this thing. But in cash, I've laid out $5 of cash, and I'm going to get $20 back. 300% profit on my cash. What do I need to do? Why would I take a risk when I can do that? I'm going to win that trade most of the time because I've got a blue chip stock, and I'm basically just betting it doesn't go lower than it is now, and I make great money. In fact, at the price it is now, 60, we're going to make from 5 bucks, we're going to make 15, 200% profit. Why am I playing a game? So the key to this is that we're protecting ourselves. And again, especially in this kind of environment, we are, number one, protecting ourselves. Number two, trying to make some money. Number one, protecting ourselves. Every single position we go into, protecting ourselves. Could you make more money doing short-term stuff and rolling and trading and this and that? Yeah, of course you can. But it's not worth it. In the long run, it's not worth it. It's not. We've done it both ways. We've been doing this for many years. So we're getting with 20 years of this crap now. So we've been doing this long enough where we've tried everything. In fact, the butterfly portfolio is obviously not at all butterfly trades. The butterfly portfolio started out being butterfly trades, this traditional standard butterfly model. And then we played it for a while and said, well, these suck. These don't really work. And so we started modifying the butterfly trades. And in fact, the butterfly portfolio is close to what you want to do. The butterfly portfolio is generally, we'll take an artificial buy right, we'll take the bull call spread with the short puts, and then we will sell puts and calls against that. So what we're doing is, again, picking a value position that's going to go higher, minimizing our costs, giving ourselves a good upside, and then selling the premium in between while we ride a channel. But that's got nothing to do with what a butterfly trade is anymore. It went, from trial and error, we just sort of settled on this thing that makes it's just a money machine, putting these plays out. And again, that's, in the long run, that's what you want. You want to make good money consistently. You don't want to jump on bets. This is not gambling is gambling. Should not be gambling. This is investing. And I'm a big advocate of that. I think you've got to have this. You've got to have your investments to fall back on. And if you want to make quick trades, you want to do this and that. We play the futures as our gambling. That's what we do. But really, when we play the futures, we're doing it to augment our bets. So even when we play the futures, we're not really gambling. We're using them as hedges. Speaking of which, how's oil doing? Ooh, look at that. See? Came down already. And like I said, we have the SCO, so anything below 60 is a big winner for us. That's all we care about. We already modified that trade from our original bet. But we would like to see, because March has 2 weeks left, we would like to see this drop down to like 58 so that we can pick up. We'll pick up on our March. I think they're 9. We have March 9 calls. We'd like to at least get 50 cents back on those. That'd be kind of nice. Wow, look at the NASDAQ. See, we knew that wasn't pretty. See, you can see that's not pretty. It's a broken W, right? As soon as you see that pattern break down over here, that's going to get ugly. It got very ugly. And this is, this is obviously, you've got your baseline, you have support 1, support 2. So we blew below support 2, you're in trouble. There's nothing here. And as you know, the long-term charts on NASDAQ. So now we expect that the Russell is probably going to follow suit and fail this line over here. The S&P is already failing that line, and the Dow, well, that's not the Dow, that's Intel. And the Dow is what we would call the laggard right now. So the Dow at 31.4 would be the shortable laggard, where it's probably going to follow suit and start falling at some point. So, and I'm not advocating playing it. These are dicey lines, so it's not like really fun. But if I was going to do it, I would have done 31.5 if I had been paying attention. That was a good line. But either way, though, this is not good. This is getting kind of ugly, and we'll see that in the long-term charts too. I got some work to do. We're hopefully closing this investment deal we've been working on for working with New Age Investments. We're raising capital, and we're going to hopefully have a project moving shortly. So I'm working on that, and we are back and forth with the investors constantly, which is why I have no voice. It's like I spend all my time on the phone doing this crap. So here's the NASDAQ. I mean, this was their support. They failed. So now we're getting some dangerous territory. They failed before. They've been down here before. You see this line, very significant, whatever it is, 12,750, basically. Okay, but below this line, they go below here, and there's really not much of a chance of support until we get back to 12. So you're talking about another 700-point drop on the NASDAQ. That is $14,000, by the way, though, if you want to play it. So $20 per point. Is that right? 700 times 20, 14,000, right? So if you want to make $14,000, that's the NQ shorts. If we fall below 700 and you keep that as a stop, and we get to 12,000, that's going to be a $14,000 profit per contract for that one. So you weigh that against losing $200, let's say, you know, if it goes up, you set a stop. But this is ugly, and it's not going to be pretty at all if this stuff breaks down. Look at the S&P is still way up here, not even close to the Dow is up there. The Russell is getting close to the same kind of breakdown as the NASDAQ. So, you know, if you see the Russell fall below, everybody's going to go down with it. And the S&P, the Dow would be the laggard right now. But these guys are not in good shape. Europe is still holding. Europe's actually doing pretty good considering. The VIX is moderate, and moderate for now. I mean, of course, in the years before this, if we go to monthly, look where we are. This is where the VIX has been for most of the time, below 20. And look where we are now. We're at the 27, 25, 27. You know, you start seeing that VIX move. If you see that VIX moving back up to 30, some bad stuff's going to go down. Put it that way. And the dollar's still low, so you can't blame the dollar. The dollar's not putting pressure on anything. That's just the way things are right now. How the bond's holding up. Bonds also falling, right? We're going to run out of support here too. The long end, see the long end of the curve is doing the worst, right? The long end of the curve is coming down. Not coming down. I mean, those are the value of the bond is dropping, which means the current interest rates are rising. So current interest rates are rising, and these are going down. So the cost, the interest paid by a 10-year note. So what happens is your 10-year note is written for, let's say 1.5%, right? You've got a 10-year note for 2%, let's say. Now, if the current 10-year note is 3%, that means your 10-year note that pays 2% is worth 10% less than a current note. That's how that works, okay? So in other words, you have a 10-year note, it has a coupon on it that says this note will pay 2% for 10 years. That's your note, you bought that. So how'd you buy it? You bought it for $10,000, right? You give them $10,000, well, you don't really, you give them a discounted amount, but you give them a discount that reflects the interest over the 10 years. But you buy it, so you pay for this note, You give them the money, they're going to return it with interest, and it will mature to $10,000 on a certain date. Now, the problem is if the new notes demand a high rate of interest, that means that the new notes are worth more than your note. Now, they both say $10,000 on them, but yours pays less interest over that period than the other guy's does. So yours will devalue at the rate of how many years are left on your note, and then times the difference in interest. So if the new notes are 1% higher than your notes, and you have 9 years left, your note will drop 9% in value. That's how this whole thing works. And that's very dangerous because people who buy bonds do not expect their bonds to lose their value. So you got to be really careful about that, because when the bond market starts falling apart, all the shit hits the fan. So we're going to have to watch the note auctions very carefully. But already the Dow's now red, the S&P is red, the Nasdaq is down more than 2.5% for the session. These are not good things. And again, that's why we're being cautious in our portfolio. That's why we opt to have more coverage, not less coverage in our positions. We don't want to take the chance that we could have sold $10 in premium, but we sold $2 in premium because we thought we'd make more money. Where instead what happens, we sell $2 in premium and we're screwed. It's not worth it. I won't give up the protection to try to make the money. That's where it's not worth it. All right, so everybody be careful out there. I'm going to wrap this thing up, and we will do it again next week. But thanks everybody for coming. I appreciate it. Oh, no, I'm sorry. There's one more thing I want to talk about. Where was it? Here you go. I'm sorry. I got to talk about this with people who are my own age, because, okay, first of all, my daughter took this as an opportunity to lecture me on my misogynist views of the world, or whatever the hell it is that's wrong with me. Because yes, whatever. Look, this is a cancel. This is where, and again, I'm a liberal, obviously. This is where the right-wing people get pissed off, and I get that, because here you go. 6 Dr. Seuss illustrations are being pulled because of this kind of racism. What kind of racism? It says here, a Chinese man who eats with sticks. That's considered racist. Okay, that's messed up. I'm sorry. We're really losing our perspective on things. And my daughter is telling me, she's like, no, Dad, you don't understand. You can't, any indication of stereotyping like that is wrong. And I'm like, but they do eat with chopsticks in China. That's what they do. It's like, I don't understand. What are what are we doing? We're not allowed to illustrate things. We're not allowed to talk about stuff. What about the magician? Should we the stereotype of a magician? It's so crazy. This is what got this book banned. That a Chinese man who eats with sticks. It's not even insulting, is it? I don't know. Maybe I'm crazy. Is it the hat? Is it the that's what they wore. I mean, it's it's like 50, 60 years ago. What other, oh, here you go, more Chinese. He's really bad about China, huh? What do they say about here? Oh, with helpers who all wear their eyes at a slant. Now, he didn't say they're Chinese. They're Zumbatans. but obviously at the time, this is obviously clearly a thing to Chinese. You can't do that. Oh, here we are. I don't know. It's the indigenous people apparently. Now the poor Eskimos. Dr. Seuss apparently had it in for, and we cannot depict the Eskimos doing Eskimo stuff. Like, I don't know. It's crazy. Here's another one of these. Oh, look, these fish were made to look like Eskimos, and that's, I don't know. And this is another, I guess, Chinesey sort of thing. He's Nazim of the Bazim, and apparently that's no good either. Whatever he's doing, I guess it's because he's smoking hookah. I don't know. All right, that one again. This is back when he was Dr. Zeus was a political cartoonist. So that's back in this is his. It says political cartoons were a little racist, but everybody was racist back in World War II. We didn't like the Japanese at the time. I don't know. I don't understand. So anyway, I just, it's something I think is worth discussing because I think it's crazy. And this is when they talk about the cancel culture and how things go too far. And I don't know. Maybe I'm an old dinosaur about this stuff. It's just, it seems to me, it's like, how do you think that's bad? How do you really look at that and say, oh my God, we're creating a culture of intolerance with our children and stereotypes and so on and so forth, and giving them negative images. I don't know. I honestly can't even articulate my daughter. Oh wait, here. Let me see. I gotta read this. I'll tell you what she said, because she's really, you guys got to talk about this with your kids and let me know what they say. Here you go. Even by drawing minorities in a poor light, things that resemble minorities can cause alienation and potential microaggressive behavior if it's the only experience the kids have with those minorities. This is my daughter. Racism, she's studying for psychology. Racism has been proven to be learned, so it's better to be safe than sorry. Oh my God, I can't take it. She also, Madeline is also, but Jackie's more like me. Jackie thinks racism is funny. Not racism, stereotypes. But Jackie and I, we go to a comedy club and we laugh our asses off. Maddie goes with us to a comedy club. She sits there with her arms crossed, like she's angry at every joke. It's so funny. And frankly, Jackie and I like that part just as much as the jokes, because the things Maddie gets offended by are hilarious. But I don't know. I mean, I don't know I don't know what's going on in the world. It really drives me crazy. I'd be curious to hear in chat like what you guys think about these things with the kids and all that, because it really is insane. All right, so since I'm still talking, let's see what's here. Todd says, question on my SIG position that has been fantastic. I've gotten behind the curve on cherry calls. Good news is they are covered. I have one short, April 37. Okay, well, okay, that's more for chat, so please ask that in the chat room. We'll look at that. And Alistair says, just to be clear, the books were self-restricted by the estate that looks after his legacy. They were not banned by an outside influence. Okay, so the estate of Dr. Zeus has pulled these things due to their questionable stereotyping. Well, that's interesting. Okay, that's better than having it banned, frankly. But I still think, what are they doing? I mean, I don't know. I mean, are they going to just ban the pages, or are they going to ban are they redacting the pages? Are they going to change it? Are they going to redraw it? Are they going to just take that page out? You can't take the page out. Are they going to just take the book out of circulation? I don't know. But it's not just Dr. Zeus, obviously. It's like the whole concept, like instead of comedy, it's, the comedians have to tread on they're like walking on eggshells when they're doing their bits now. Everybody's got to be careful. Poor Kevin Hart got killed for saying they made some gay joke like 5 years ago and got in trouble for that. I don't know. People got to redevelop a sense of humor about things, I think. But again, I'm a privileged white male. So I'm not affected by these things. I am Jewish. I mean, I guess they've got some sensitivity towards stereotyping and such, but I mean, that's why Jews invented humor, basically. The reason there's so many Jewish comedians is that was the deflection of many hundreds of years, is to laugh about it. It's easier to you laugh about it, you make fun of it, whatever. And frankly, a lot of the black comedians did that too. They made fun of the stereotypes, made fun of it, and changed the culture by bringing the stuff to the surface and by talking about it. I think when you sweep everything under the rug and pretend it doesn't exist and pretend that there's no stereotypes and so on and so forth, I don't think you're really helping. I don't, because and again, I'm telling you, I've seen Madeline is so sensitive to all these things. I hope she doesn't listen to this. She's so sensitive to these things, and it makes it hard to function. You know, there's many slings and arrows that are going to be thrown at you in life, and to consider them too dangerous to even allow to be discussed or to be looked at, I don't know that it's really helping. I really don't. And unfortunately, it's like a huge social experiment we're conducting on ourselves, and we don't know what the outcome's going to be. So that's my soapbox for the week. All right, thanks for coming, everybody. We'll do it again next week. Take care.